types of ratio analysis. So we're looking at liquidity ratios, and the first one we said is the current ratio, speaking to the ability to meet short-term obligations from current assets. So current assets should always be above the current liabilities at all times, or else there's going to be a problem with meeting short-term obligations. So the general benchmark, not specific to industries now, generally is supposed to be 2:1. So 2 times your asset and 1 your current liabilities. Your liabilities should be 1 and your current assets should be 2 your current liabilities to be in a comfortable position to meet your current liabilities. Okay, so the next one is the quick asset ratio, also known as the acid test ratio. After deducting inventory from the current asset, we want to see if you can still meet obligations, especially for manufacturing companies. It's a more stringent test that removes liquid inventory because they want to test to see, without inventory, especially for manufacturing companies, can the company run on a day-to-day basis? And that's why it's called the acid test. So the quick asset ratio is also a liquidity ratio to measure how you could meet, or a company could meet, its day-to-day obligations. Very important. We also have the unpopular absolute liquid ratio, which is also known as the cash position ratio or the overdue liability ratio. It's also a numerator against the current liabilities, and it consists of cash in hand, cash at bank, marketable securities, and short-term deposits. So everything that has to do with cash and bank, aside inventory, aside receivables, is absolutely liquid. So combining all of them to see how, if this is measured as a numerator against the current liabilities, if it's above 1 to 2, then with liquid assets, day-to-day obligations can be met. It's not a popular ratio, but then it's good to know this ratio, especially for banks, investment companies, and some other sectors that these ratios apply graphically to. Also, the interpretation, larger ratios indicate better short-term solvency. Very important. And the interpretation is what is necessary, not just the calculation. So larger ratios, like for current ratio, if you have 2:1, 3:1, it's a more comfortable position. But where you have 4, 5, 6, it may speak to too much liquidity and tying down too much assets. So balance is very important, is the key. So too much working capital could speak to idle cash, loss of income, inadequate working capital, and that's for lower ratios. Could be inadequate capital, working capital, and risk of winding up, because if you cannot meet to your day-to-day obligations, then your future will be truncated. Very important. So balance is the key. You should not have too much working capital, and you should not have too less working capital. This is key. So balance between liquidity and profitability to remain in operations is very important. So that's for current ratio. Let's also look at operating cycle that relates graphically to working capital cycle. Operating cycle speaks to the time to convert investments back into cash, inventory investment to be specific. So for manufacturing companies to some extent, and those that deal with inventory, whether manufactured or bought to be resold, turning the inventory back to cash is key, because inventory is a key component of your current asset. And most of the time, those inventory are sold in cash or on credit. And recouping those credits takes a period of time. So that operating cycle is very important. So where inventory is sold for credit, the days and the time to quickly convert that credit to cash is what we are measuring in the operating cycle. So the phases, especially for manufacturers, you have the raw material phase, the purchases, then production, then the inventory comes on. After inventory comes on, there's sales, and the sales come in either forms of credit or cash. And if it's credit, you have receivables, and it may take time to recoup those receivables, then cash is collected. So these are typically the phases that speaks to the cash or speaks to the operating cycle of a business. This is very important. So we also have the phase of those that resell inventory or a service. We have the sales, which is revenue. Then we have the receivables. If it's on credit, then cash is collected. And that's another phase for those that resell products or services in form of inventory. And the formula speaks to inventory divided by cost of goods sold at 365 days, which is typically a year if it's not a leap year. So the number of days in inventory is calculated, and under exam condition, you use the closing stock or the average between a particular year. So if you're just giving 1 year, you use closing stock as your inventory. And if you're giving 2 years, maybe 2020, 2021, 2022, 2023, you divide those 2 years by 2. As we look at examples, we'll see graphically how to calculate them. We also have the number of receivables where you sell on credit. And the number of receivable days is the account receivable, which is credit sales divided by, your account receivable, which is your current assets determined, divided by your sales on credit by 365 days. So this area is very important because we need to be able to determine what we sold on credit and how fast we can recoup it in number of days. Very, very key. Okay, so the formula is clear on the screen, and it's account receivable divided by credit sales times typically a year. So take note of that. Now, somebody has asked me, what's the difference between account receivables and credit sales? And I believe we want to know the difference. Does anybody know the difference? Accounts receivable that shows up in your current assets and credit sales, which is part of your revenue figure. What's the typical difference? Can anybody share?
Is it not the same?
Is it? Yeah, go ahead, AC.
It's not the same thing.
No, it's not the same.
Oh, I used to think it's the same one.
Yes, and that's why I asked that very critical question. Somebody asked me, and yes. Okay, does anybody want to try to give us the difference between account receivables and credit sales? Just try.
Okay,
just try.
Can I try?
Yes, please, go ahead. Yes, feel free to speak. Yes.
Okay, so basically, credit sales is what leads to account receivables. Okay. Because, for instance, when we have a credit sale of, let's say, 100,000 naira, and the customer is now made payment of let's say 40,000. The credit sale that we made to the customer is 100,000, and at that time, after that 40,000, the receivable of that customer will be 60,000 naira. So credit sale is the origination, more like is the origin to account receivables, basically.
Fantastic. Thank you very much for that explanation. That's clear, lucid, and the picture of what's the difference between credit sale and account receivable. Let me just add flesh to what he said, which is very correct. Credit sales, let's define it. They are sales made to customers on credit, exactly what he said, meaning the customer does not pay immediately, but agrees to pay later. So when it happens is that at the point of sale, goods and services are received, but payment is deferred. Take note of that. So he gave an example of 100,000, 60,000, 40,000. So I'll use this example. You sell goods worth 500,000 to a client with a stipulated period to pay within 30 days. So you have 30 days limit or timeline to pay for that credit. So that transaction is recorded as a credit sale. Take note of that. So 500,000
Under
naira
asset.
to a client. You said?
It's okay.
Go ahead,
Go
AC.
ahead. Sir, sorry. No,
So
go
that
ahead.
credit
Sir.
sales is recognized based on IFRS 15 as a sale. So it's revenue, but it's a credit. So you are free to recognize it. IFRS said if you've performed the obligation, IFRS 15 says you can recognize it as revenue. So if you sold on credit, you recognize it as revenue, not as an account receivable. So now, an account receivable, let's define it. This is the total amount owed to the business, your business, by customers from past credit sales that haven't been paid yet. AA said it. So it shows up on the balance sheet as a current asset representing money yet to be collected. So out of that 500,000 within a 30-day period, if he pays 300,000, then your account receivable is 200,000, which will go to your accounts receivable. 300,000 has been paid, but 500,000 is still your credit sales. So take note of that. So a simple analogy, credit sales is what is sold on credit. Account receivable is what is still outstanding and yet to be collected from the credit sale. Very simple. So it means credit sales sold on credit, account receivables unpaid amount from credit customers. And the credit sales is recorded in your SCI, but your account receivable is posted to your balance sheet or SFP. And the timing of credit sales is at the moment of sale. Then account receivable is after the sale until payment is received. And changes is when a sale is made on credit, then also customers pay. When customer pay, the balance is when receivables is generated or decreases. So those are typically the differences between credit sale and accounts receivable. I hope we're a bit clear on that. All right, so let's continue. Take note of using the closing receivables or average receivables in the calculation of your accounts receivable days. Take note of that. The closing receivables in case of maybe a 1-year financial statements, then average in case of 3 years financial statements. Those are dynamic nitty-gritties we'll look at when we're solving past questions. So in the operating cycle, we're looking at conversion of inventory to cash, especially when you have receivables. So the purpose is to determine the working capital needed. And when you have a longer cycle, a longer days, the more current assets are needed or tied down. So more net working capital is required. But the shorter the days, it's better because inventory is recouped in form of cash to run the day-to-day activities of the business. So we have the more clearer picture, which is the net operating cycle that includes payables. This one is more appropriate for liquidity required because the number of days in inventory plus the number of days in receivables minus the number of days in payable is what gives us the net operating capital, which is a clearer picture different from the operating cycle, which just deals with the inventory and the receivables. So the net operating cycle is the number of days in inventory, like we've calculated, and the number of days in receivables added, then deduct the number of days in payable. And the number of days in payable is your accounts payable, which is a debt, expenses you owe in the short run, and is divided by the credit purchases you made. Take note of it, credit purchases. Where you don't have credit purchases, you use your cost of goods sold. It's a replaceable denominator for this expense. So you use your accounts payable divided by your credit purchases or your cost of goods sold expressed in a year. So the longer the net operating cycle, the more liquidity is required, but the shorter, the better, because the what to run with. Okay, so that's it for liquidity ratios. Let's look at efficiency and activity if we don't have any questions on those ratios, the formulas and the interpretation. So the efficiency ratios measure efficiency of how assets are used to generate revenue, and the higher the ratio, the better. The higher how many times you are able to convert your assets to revenue is better. So where you have sales of 4 million, and your total assets is 1 million. That means you've done 4 times your total assets or your capital employed or your investment in assets, which is better. But the lesser, it's not good for the business. It shows that you are underutilizing the assets. That's the interpretation. So where you have sales of 4 million and you have total assets of 8 million, that's half the capacity of that asset you've utilized in that period. So the higher, the better. So total asset turnover, and your total asset is your fixed, which is your non-current asset plus your current assets as a denominator, and the numerator is your revenue to generate your total asset turnover. We also have the net asset turnover, which is also known as capital employed turnover. We have the net asset. When you hear net asset, you know it's your total assets less your current liabilities. So you're trying to see how much your revenue is above your net assets. And it measures the rate at which net assets to capital employed generates sales or revenue for the organization. So non-current asset turnover is the next one. I would like to stop here and engage us. Can somebody tell me the difference between sales and revenue? ACA, Zachariah, do you think they are the same? Let me engage us now. What's the difference between sales and revenue? Some people think it's the same. Can somebody try?
I didn't know the same. Sorry. Okay. Well, I was thinking about the same.
I know ACA will say so. Please, AA, go ahead. Let's hear you. Let's hear your thoughts on that.
Excuse me, sir.
Yes,
All right.
please.
Okay.
Sorry,
okay,
AA. Sorry, AA. Let ZM land. Please go ahead, Zachariah, before AA speaks.
Okay, let me just try. Revenue are those are the sales you made, maybe based on cash or you are paid. You know, understand? Okay. Then maybe the sales encompasses all your credit sales, and encompasses your credit sales. Let's just leave it at
that. Nice try. I love that. Nice try. At least you tried. I like that. Okay, AA, let's hear you, please.
Okay, I would say that sales is more like a subset of revenue. Revenue is more like it encompasses all aspects of the flow of income to the business.
Yes.
While sales is basically the primary source of primary business that the company is into. That's my feel.
Yes, I love your feel. I like your feel. I like ZM's feel too. He expressed himself by resonate. Your explanation, AA, resonate more with me. So let me provide more context. Sales and revenue. The difference is that sales, look at it this way, it refers to income generated from selling goods and services that are part of the company's core operations. So it's often called gross sales or sales revenue. You hear some term. So AA used the term, he said, is a subset of revenue, and I agree with him absolutely. So it's a subset. So for example, if a bakery sells bread or cake worth 5 million in a month, then 5 million is its sales. So get that. So sales is directly from core operations. Now, AA said something. He said this revenue is all encompassing. I love that word. That term, all encompassing, is correct. And all encompassing just means revenue is broader. It includes sales plus any other streams of income. Take note of that. Revenue includes any other streams of income. So other streams of income for a business could be rent. You have property somewhere and you generate rent. Or you are in a building, you let out a particular outlet, or in that building, you let a particular place out for rent to another business. And every year you're collecting rent. That's part of your revenue. You bought shares from maybe the profit of the company from another company, and that shares is giving you interest or dividends. Okay, sorry, shares don't give interest. Maybe you borrowed out money as debt and you told them you pay in 5 years, but every year you must pay interest. So as that interest is coming, it's called investment income. It's part of your revenue. You also have areas like royalties. Maybe you have an intellectual property or you gave your expertise somewhere and you are generating your royalty from that property or intellectual property every year for your business. It's also part of your revenue. You sold an asset, maybe gains from asset disposal. You classify it as part of your revenue for that year. Then if it's an NGO, you maybe get government grants or grants from donors. It's also part of your revenue. So you can see that revenue is all encompassing in the words of AA. I agree. So it's broader. So let me use that bakery, for example. If the bakery earns 5 million from selling breads and cakes, and it has 500,000 from interest income that he borrowed funds out to another business to use and they are generating income, then the total revenue for that bakery is 5 million plus 500,000, which is 5.5 million. So in sourcing terms, definition of revenue is that it's income from core goods and services sold, but revenue is the total income from all activities of that business. And it includes, for sales, only primary business activities. And you can use an example of the sale of cement by a cement company, or the bakery I used as an example. Then revenue includes sales and other income streams. And the example, you could say sales plus rental income or interest and all that. All right. I love the engagement. It's appreciable. So it's good we get one or two of these nitty-gritties, and the engagement is nice. I appreciate it. Thank you for your thoughts, ZM and AA, on that. Yes, please go ahead. Yes.
I have to move on. I want to get drugs for somebody. Please.
Okay. Please yeah. Go ahead. Thank you very much. Thank you. Okay. So we're looking at net asset turnover, and we said net asset, the denominator is your total assets less your current liabilities, and your sales or your revenue is the numerator. Okay, so the next one is your non-current assets to turnover. Not current asset turnover, speaking to sales or revenue, and your non-current assets as the denominator. Non-current assets is fixed alone, and you want to measure the rate at which non-current asset generates sales. So the higher, the better. So if your sales or revenue is about 4 million and your non-current assets invested is 2 million, so you have 2 times sales generated from non-current asset, which is commendable. So we also have the next ratio, which is inventory turnover, and it speaks to the cost of sales divided by average inventory. So the cost of bringing the services to get revenue divided by that revenue, that sales activity, which is inventory generation or production. And it measures how many times inventory is bought, sold, and used in production per year. So the cost of goods sold or the cost of sales is the numerator, and the average inventory is the denominator. So alternatively, like we saw in the liquidity ratio, you have the number of days. So you just transpose the formula from average inventory as the denominator to the numerator and cost of sales as the denominator. And that's the formula we looked at in the inventory, in the liquidity ratios previously. So it's an alternate way of expressing the relationship of inventory turnover to see how many days it is. It's the same formula, but you just juxtapose the components or the items up and down. We also have the trade receivables turnover, speaking to average trade receivables, and it measures how many times credit sales is created and paid for within the period under review. So the average, the trade receivables turnover is looking at how many times credit sales is created and paid for. Also, we have alternatively the trade receivables collection period in days, and is expressed by average trade receivables, which is maybe 2 years or 3 years. You do 2021, 2022 divided by 2. We express it as credit sales. And if you don't have credit sales, you just use your revenue figure times 365 days to get how many days And the former formula we spoke to, the turnover, is how many times. Then we have also the trade payables turnover period, speaking to credit purchase or cost of goods sold divided by the average trade payables for the period. And this measures credit purchases created and paid. So alternatively, you have the trade payables period in days, and you have the trade payable period divided by either credit purchases or cost of sales, and you express it to have how many days it takes to pay off your trade payables and how quickly it is. Okay, so that's it for efficiency or activity ratios. All right, so let's look at the next one, speaking to long-term solvency and leverage ratios. Looking at the formulas. The first long-term solvency ratio is capital gearing, which is a principal or cardinal ratio in this category. We have your preference share capital, which is your restrictive covenant, and you have the non-current liabilities, speaking to debt, as the numerator. Then you have your total assets, your total capital, including short-term and long-term, as your denominator, to get how highly or lowly geared your company is. When you say a company is lowly geared, you are saying it's more ordinary share driven. Or if it's highly geared, you are saying is external debt or external capital driven. And the capital gearing ratio measures the extent to which long-term funds are from lenders. It's very important. Then we have the debt to equity ratio, another ratio, speaking to external debt and internal funding, which is equity. It measures the relationship of debt to equity. And it's a cardinal ratio also. We also have the interest cover. We've spoken about that, speaking to borrowed funds or external funding and how interest could be paid. And it measures how many times interest could be paid from profit from borrowed funds. So the formula is profit before interest and tax divided by interest payable. Okay. Also, we'll be looking at the next one, which is the investment or shareholders ratio. Investment or shareholders ratio. Okay, I was struggling to toggle to the right slide. So the investment or shareholders ratio speaks to earnings per share. And the formula is your profit after tax less restrictive covenants, which are preference dividends, divided by the number of ordinary shares in issue for ordinary shareholders. And the result is provided in kobo to determine the profit earned per ordinary share held by each shareholder in that business. We also have the price earning ratio, which is the market price per share divided by the earnings per share. And it's the years it takes to recover the market price if earnings from the profit after tax over the years remains constant. So the price on the stock, on the floor of the stock exchange, is what is used to express this earnings per share. Then we have the dividend cover, which is the same denominator, but then divided by ordinary share dividend, which is the dividend per share. And it speaks to how many times the ordinary dividend could be paid from profit. We also have the dividend yield, and it's a dividend speaking to the percentage of the market share. So the dividend per share divided by the market price per share expressed as a percentage. So that's it for investment ratios, and it will resonate with us when we look at an example that has this component of ratios to practically calculate, interpret, and explain in the case. So every ratio we've spoken about, we need to graphically illustrate that, and that is why we need to take past questions and look at how the examiner tests it and how he explains and interprets it in his report. This is key. Okay, so that will be the end of ratio analysis, its explanation, and the detailed elaboration. So let's come to a detailed unit speaking to the financial statement analysis in the exam in detail. We looked at an introduction, I think in unit 2 or 3. So let's look at in detail what it takes to perform financial statement analysis in the case study. So the accounting information provided to you usually are truncated financial statements, in the sense that you either have management accounts or financial statements that are not full financial statements. They are extracts or summaries. So that's what is presented to us in the case study exams. And the assumptions is that accounts are rigorously prepared by competent professionals, of course, and they are suitable for audits unless they are stated otherwise. So auditors challenge them, and that's the role or the hat you are wearing in the case study exams, to challenge assumptions, to challenge numbers, and to look critically and skeptically into these figures. And that's why most of the time you see management accounts are provided, not really financial statements. Very few times you see audited financial statements provided. Most of the time you see they are unaudited or they are management accounts. So that's the assumption generally during the case study exams. So there are steps in performing this financial statement analysis. So comprehensively, and you need to complete the procedure by first an initial analysis. You look at the bird's view. You go through initially the documents and the components. You look at the SCI, you look at the SFP, and you look at the, if provided, the cash flow statement. You also, the next thing is to do a detailed analysis, including ratio analysis. And the third step is to use the financial statement analysis in the case study to explain these numbers. So practice is key, and this cannot be overemphasized. Practice, practice, practice. And that is why we'll be looking at past questions. By the time we should finish this lecture, 222, we have 11 chapters in the case study. We should have practiced 5 questions. And that will not downplay the fact that you should go back also and write and rewrite these reports by yourself. Because what I may be teaching you, you'll just be following through the side, but you will not grasp the concept and grasp the technicalities around that if you don't do it yourself. So I tell my students, if you want to pass the case study paper, please practice at least 3 past diets, at least 3. You are very busy, 3. If you're not busy, 4, 5, 6, it will help you fine-tune your skills, your writing skills, your report writing skills. So practicing is very important. So don't take the 5 past questions we're going to be taking as, oh, he has treated the questions, he has sent us the report, I've read it. Please go back and practice. Practice it by yourself. Take the past questions, take the pre-seen, take the unseen, and do the report yourself. Do the appendix, write the report, and if you can scan it to me and send it, I'll mark it for you and give you my honest opinion on your performance. I will even score you based on the criteria and the boxes. Excuse me. So practice is key. Developing good financial statement analysis skills takes time. You can't do it on the day of the exam. Just imagine Cristiano Ronaldo wants to play the Champions League final and he doesn't train at all till the day of the Champions League final. He's not going to perform. Most of the time, you see these footballers having very, very rigorous training before the day of the match. So you need to rigorously practice to be able to ace the case study paper seamlessly. So there's no substitute for doing this analysis and practice yourself. Not even me, your tutor, can do it for you. So to appreciate the complexity and to build speed, you need to practice. You need to practice. Like I told you in the initial lectures during the review, I said I wrote May 2019 diet, which I scored 78 at first attempt. Now, case study started in November 2014. I practiced from November 2014 to November 2018, all the diets. I think there are about 8 diets. I practiced them by myself with the help of the tutorial video I was using. So passing case study is not rocket science. You just follow the steps and that process leads to the result. So please, practice is key. Don't substitute these lectures for practice. These lectures will just give you an idea to make you understand what to do. But the doing is you that will take that responsibility. Very important. So it's no substitute for doing the analysis yourself and to appreciate the complexities. And you will see that time, that 4 hours is very short. If you are doing the case study maybe for the first time in the hall without practicing, you find that that 4 hours is very short. You will even be confused if you've not practiced before. So to build speed, that's what practice does. It helps you build speed. You'll be fast. When you give yourself 4 hours, no supervisor, no invigilator, nobody is supervising you. Give your first 4 hours to write the report. You build speed and capacity. Very important. Okay, so let's look at initial analysis. The rapid review to establish financial headlines and overviews is what initial analysis is. So once you're given a financial statement, you initially look at it. And the overview and the headlines is what you're looking at. And this includes the nature of the business. What services are they providing? What products? Is it retail? Is it a manufacturing company? Is it an NGO? Is it a hospitality business or a hotel? So is it expanding or a contracting sector? So you're looking at the nature of the business first, and that's what initially you do in financial statement analysis. You also look at the impact of recent events on the financial statements, foreign exchange, technology, AI, and electronic commerce impact. So these are initial analysis you perform. You look at the life cycle stage of the business. Is the business a startup? Is it growing? Is it maturing? Is it shrinking? Is it static? And you look at also organic or acquisition growth. Did it grow as a result of merger or buying another company? Is it growing based on its product and services year in, year out? So that's organic growth. You look at the profitability. Is it good profits it's making? Is it marginal profits? Or is the company making losses? So these are initial analysis and the parameters to look at. Are the profits stable or erratic? Is the company performance generally stable or also erratic? So these are initial analysis you perform. Also, you look at the size of the company. Is it a small company? Is it a medium-sized company? And this is measured by the revenue of the company, the profits, the assets. Is it a single company or a holding company or a group? Is the company involved in cross-border transactions, national or international or a multinational company? Is the company publicly listed or a medium-sized company or a small company, quoted or unquoted? What is the share volume of the company? So these are things you look at from the financial statements to determine or initially understand the company. Is the company stable? Speaking to its financial well-being. Is it financially well structured? What is the debt to equity? Is debt above equity? Is equity above debt? Is the company solvent? Is able to meet its short-term, long-term obligations? The life expectancy of the business, is the startup, is it expanding? Is it declining? We look at also the budgets and forecast if provided. Is it achievable in line with the company's strategy? So these are initial analysis and parameters you should look at, which is very important. You also look at the wider context. What is affecting the economy what is affecting the company macroeconomically? Are there recession? Is there depression? Is there recovery from recession in the environment the company operates? Are there home-based products or imported products? Do the company do exports? Is there inflation or stagnation? Is finances available for the business in form of banking constraints, quantitative easing? What are the interest rates? So these are the wider contexts you look at as you are reading through the exhibits. You also look at fiscal policies from the Apex Bank. What stimulations and restrictions, what trade tariffs, what quotas are available if provided in the case. You take note of this in your initial analysis. You also look at integration. Always integrate analysis when you're doing the case study exams. Look at the exhibits. You understand a growing business in a strong economy, but is growing slower than others may not be succeeding. And a growing business in a weak economy is growing faster may not necessarily mean it's succeeding. So the integration of these factors should be properly analyzed. This is very important. So avoid rapid final judgments and investigate deeper, reading between the lines, and be skeptical in your analysis. Very, very important. Okay. For detailed analysis, you need to review 3 key documents and their interconnectivity. And you know the documents, you need to remember the relationship between these 3 statements and the subjective bridges. They are called subjective bridges, the 3 documents. And they affect profit and the SFP, speaking to your closing inventory, which is including your work in progress that starts from raw materials, work in progress, and finished goods. So your depreciation, amortization, impairment, deferred income, provisions for doubtful debts, which is currently the IFRS 9, looking at expected credit loss and all those models. Look at accruals, prepayments, and evaluate materiality of these changes. So the inventory figure should be looked at and should be bridged between the profit, which is your trading profit and loss account traditionally, and currently we call it the SCI, and what is in your closing inventory in your balance sheet. So that bridge should be built in your detailed analysis first. So your income statement, which includes your statement of changes in equity, you're looking at how the business is performing. From revenue trend, you look at the total revenue stream, its total income, significant sales mix, changes and effects on the profitability of the company should be looked at in detail. The gross profit and the trend, are they absolute in percentage? Is it higher than the direct cost or the cost of goods sold? The margins, are they consistent across the products with the cost? Look at the cost pattern versus revenue. Is it rising or is falling? What is causing the inconsistency or changes? These are detailed analysis you need to perform. The cost also, the fixed ones and the variable ones, which are direct and indirect, the operational gearing, the debt and mix, and the material anomalies in the single cost figures should be looked at critically. Your operating profit, the profit before interest and tax, profit before tax, are they satisfactory? Are they stable? What is the rate of increase and decrease? If you have different years, you look at the trajectory and the antecedents, what the company is doing over the years. The consistency of the bridging we spoke about, speaking to the inventory, the depreciation, deferred income, impairment of receivables, accruals, and prepayments. What is the materiality of it? Are they material amounts? Are they huge amounts? Look at the tax charge. Is it reasonable? The taxes. Look at the dividend policy. Is it appropriate and consistent? So these are things you should look at in your detailed analysis. And the key is to provide skillful commentary, explaining every numerical changes and whatever you noted in the figures. So the first one is the income statement to look at. The second one is the statement of financial position. And the position statement is the quality of assets and liabilities. Are they weak or strong? And doing a quadrant analysis will help you understand the non-current assets and the long-term funding. Is it balanced? There is danger if non-current assets are funded from current liabilities. Danger, because your current liabilities are supposed to fund your short-term obligations. So the quadrant analysis will help you understand that your non-current assets, which are fixed assets, are to be funded from your non-current liabilities. So you also analyze in detail the current assets and the current liabilities. Are they balanced? Is the current liabilities overloading the current assets? This is important. What is the quality of assets? Non-current assets, looking at your tangible assets, what is their market value? Or your intangible assets, goodwill, intellectual property, are they sellable in crisis? What is the value, the independent market value? So these are detailed analysis you need to look at. What is the quality of liabilities, long-term funding, equity, retained earnings, or risky long-term debt? Is the debt hard or soft? Soft debt, includes director loans, and hard debt includes external high interest debentures, short redemption, debt, the repayment and due dates, the funds available for repayment, linking them to cash flow from financing activities. So these are areas you need to look at in the liabilities in your detailed analysis. Also, the current assets, the main inventory. Are there slow receivables or sufficient cash or near cash items? The current liabilities, are they softer? That means the trade payables, the accruals, that's short-term liabilities. Trade payables and accruals are mostly softer, while the harder are bank overdrafts that attracts interest and they need to be repayable in a particular period. Also, non-negotiable taxes in form of deferred taxes. These are harder expenses you need to look at. And you need to use the notes to the accounts for more detail. This is very important. The notes to account will give you a clue to most of the figures in those components of financial statement. And the third one is the statement of cash flow, if provided, which he rarely provides, just one of two few diets he provided cash flows. In using this to generate cash, and the cash flow is actually the first statement in our opinion. It's the relationship between the operating results and cash generated and utilized for the business. It's actually the starting point because it combines information in the SCI and the SFP, but it reveals actually the actual financial management of the company. So management insights speaks to each line of these financial statements, providing financial activities and management quality, credit control, board decisions, which is very pivotal in the preparation of these financial statements. So key questions you should ask is the success in operating cash. You start with operating cash plus non-cash items for the direct method of preparing cash flow statements. Then you look at the working capital managed versus the activity changes, speaking to cash absorbed and cash absorbed by inventory or by receivables. Look at payables managed effectively and responsively and linked to all the ratio calculations. So the cash generated from operating activities is very important. You also looked at appropriate return from investment and also significant finance servicing payments. So the cash flow impact of tax payments also, is it consistent with the liability? Very important. So the capital and the financial investment policy of the company, the appropriate non-current asset replacement policies, are they actually followed and implementable? So the proper long-term funding of the business and also dividend policies, are they appropriate? Are they issuing out dividend more than retained earnings? Can the business afford payments? So these are things you should link between the cash flow and the statement of comprehensive income. Also, the long-term financing strategy, is it appropriate? And the best use of liquid resources are areas you should look at. And cash balances, are they fluctuating or reducing? What is the amount held? What is the minimum amount held? So a structured analysis, the use of each line of opening and closing balance changes is very important in your detailed analysis. This is key. And also, the ratio analysis we spoke about is not a tool. It's a tool, but not an end goal. It's just a tool you use to arrive at your analysis and your explanations. The starting point is basic ratios like we've spoken about, the profitability, liquidity, efficiency, solvency, and investment. It must be calculated accurately to some extent, and you must do it speedily because you don't have time. So the real skill is the explanation of these ratios, the results, and not in the calculation. It means evaluating the causes of the changes in fluctuation, either up or down, of those ratios. This is very important. So that's it for the financial statement analysis and how it's presented in the case study exams. So the initial analysis, the detailed analysis, and the three statements, the bridges, understanding how to tackle them, which we'll be doing practically with a past question, or the past questions we'll be looking at will help us and it will resonate with you practically. We have 2 more units for the end of this financial statement analysis. But unfortunately, it's already 10 p.m. 2 hours. A lot of us have gone to work back. I don't want to keep us any longer. So we'll stop here. Hopefully, either on Friday or Saturday,